Hey, welcome back, everybody. Today is Wednesday. We're still working in chapter 6 today. Um, we've gotten through all the slides. We did that on Friday, and on Monday we went through some typical transactions we'd expect to see in these type of proprietary funds. I just want to go over a few things before we start in the content. It was brought to my attention that midterm grades are actually due next Friday. So it kind of puts a wrench in my plans of doing the midterm next Friday. There's no way I could have midterms in if we did them next Friday. Usually they give us to the Monday at 4 o'clock following the week of midterms to get all the midterm grades in, but that's not the case this semester. So with that being said, our exam's going to be on Wednesday next week. That'll give me plenty of time to instead of cutting it close, but give me a day or two to try to get the grade, the midterms graded, and then everyone's grades averaged and reported by Friday afternoon. So that's the thing I want to point out. Midterm exam will be next Wednesday. Okay, so we're in this week here, 24th through the 1st. So we're wrapping up chapter 6. We'll be wrapping up chapter 6 today, and then Friday and Monday we'll be doing an exam review. We'll just be reviewing over some topics that we'll be seeing on the exam. So finish chapter 6 today, review for midterm exam Friday, review for midterm exam Monday if needed, and then midterm exam on Wednesday. And then on Friday of next week, we'll be going over the project for this course, which will count for 10% of the overall grade. So that's kind of where we're at this week and next week. Just main thing is midterm exam next Wednesday, chapters 1 through 6. Okay. And it's in this class, so it's in room 207. This class, just for those that are listening, it's a hybrid course. You must come to class to take the exam, so no excuse. So let's go ahead and let me get back in here. It's in my little thing here. Let's just see where we were. Sorry, just see where we close the entry. It is okay. Just bear with me just a second here. All right. So we left off on Monday. The materials and supplies in the amount of 291,500 were purchased during the year. So we set up that liability. We received the materials and supplies for that amount and set up the accounts payable. So next, when materials and supplies are issued to the departments of the Water Utility Fund, operating expenses are charged for the cost of materials and supplies. Materials and supplies issued for use for construction projects are capitalized temporarily as construction work in process. So that's important there. So anytime we have these materials and supplies that the supplies fund has, anytime that those are going to be used within building something, it's going to be temporarily capitalized only if they're used for that purpose. Okay, so we're going to temporarily capitalize it in construction work in process. So if we're incurring these expenses, then obviously this can be the relative journal entry. We incurred an operating expense for the cost of sales and services for $110,400. Incurred operating expense for administration of $60,000. Construction work in process. Remember, this is the materials and supplies used for that work in progress. So we're going to temporarily capitalize it into this construction work in progress account here for $127,600, and then obviously credit materials and supplies of $298. Right. So we've consumed these supplies and these relative expenses, and we've reduced our supplies on our balance sheet. Right. Okay, next it says payrolls for the year were chargeable to the accounts in the following entry. Taxes were accrued and withheld in the amount of $90,200, and the remainder was paid in cash. So obviously we incurred operating expenses, cost of sales and services of $253,600, operating expenses related to administration of $92,900, operating expenses for selling of $17,200, and then the construction work in progress of $58,900. It says that we withheld the taxes accrued of $90,200, so that's why we're setting up the liability of payroll taxes payable, because we withheld that out of their checks, and then crediting cash for $332,400 because that's the amount the net pay going out for the payroll. So it makes sense, right? So it's similar to all other entries we've seen here. Okay, enterprise funds commonly undertake large capital projects that are financed through bond offerings. For example, it says the water treatment plants or municipal stadiums. Unlike those construction projects studied in Chapter 5, recall those were governmental funds. Enterprise funds do not use capital project funds. Both the bonds and the capital assets are recorded directly on the books of the enterprise funds. It's common for governments to incur interest during the construction phase of a major capital addition. In a recent standard, GASB clarified the accounting for interest incurred during the construction phase by requiring such interest to be expensed rather than capitalized. So we're going to assume that bond interest in the amount of $189,000 was paid, okay? So obviously we're going to debit non-operating expenses, interest for $189,000, and credit cash. What's the difference here from what GASB clarified for the accounting treatment for interest incurred during the construction phase that's different than that of FASB? What's the difference in the treatment that we see there? Because in our for-profits, I don't know if y'all have covered it in intermediate or not yet, but usually when you're building like an item or a fixed asset and stuff, interest incurred up to the point while you're building it, it can be capitalized. GASB here is saying interest incurred during the construction phase needs to be expensed. So that's the main difference there. So just remember, interest incurred in these proprietary funds when building these projects and everything, the interest incurred during that phase is going to be expensed. Okay, construction projects on which costs totaled $529,300 were completed and the assets placed in service. So the cost of the asset is reclassified from construction work in progress, and it's reclassified to utility plant and service. So I want to point something out here. So remember, when we're using materials and supplies during, like if it's used for work in progress, right, then we're gonna capitalize it temporarily in that construction work in progress account with an original debit, right? So what they're saying here, now that construction work in progress is complete, right, for the full amount of $529,300. So all we're going to do now is just merely switch the account. Same way we move unearned revenue to revenue to unearned revenue. Now we're just moving this from a construction work in progress to a utility plant in use, right? So therefore we just debit the utility plant in service and credit construction work in progress, right? Because that reduces our construction work in process by the relative amount, and it creates the utility plant in service, right? So now we've established that on the books as well. Another thing I want to point out here, The construction work in progress account here is not subject to depreciation, right? Because we're merely holding that there temporarily capitalized because we know eventually it's going to be capitalized into a depreciable asset. So obviously, utility plant and service will be subject to depreciation, right? So we will be counting depreciation on that in any way that we normally do, whatever the useful life is, and whatever management sees is the best appropriate method for depreciation. So which one of these accounts is not subject to depreciation?
The construction work in progress.
Right. So obviously, the utility plant service is right. And when do we use that construction work in progress account again?
It's capitalized from supplies temporarily.
Right. When we use materials and supplies to incur it in construction or something, we're going to hold it temporarily capitalized there, right? Until the project's complete. Right. Awesome. Okay. Next. It says payment of accounts totaled $275,600 and payments of payroll taxes amounted to $81,200. So obviously, debit accounts payable for $275,600, debit payroll taxes payable of $81,200, and credit cash $356,800. So obviously, we're just paying liabilities here. Debit the original credit, and money's going out the door cash, so it's reducing our asset on the balance sheet, right? Simple enough, just paying off some liabilities. The Water Utility Fund received $10,000 cash from the Supplies Fund as a partial payment of the long-term advance. Remember, we sent them $200,000 that was going to be repaid in equal installments without interest and non-interest bearing. So now this is just the Water Utility Fund receiving money back from that Supplies Fund. So obviously, if they're receiving money from it, we're going to debit cash. It's an original asset. It's increasing the balance on our statement. And then credit long-term advance to Supplies Fund, because remember that was the original asset that the Water Utility Fund set up when they sent that transfer out, right? So that's cash coming back in and reducing that asset of the receivable. Pretty much is what that long-term advance to Supplies Fund. Because remember when they said like a couple of chapters ago, if it was going to be expected to be repaid within the period, it was going to be a due to or due from. Remember, and if it was going to be longer than a year, then it was going to be labeled as an advance. So that's why we're seeing it as long-term advance. Remember, we want to be real specific with our terminology when doing journal entries, because ultimately that's what's going to populate the statements, right? So we want to make sure we're placing them in the correct location on those statements. Okay, during the year, the Water Utility Fund made a transfer of $200,000 to the Fire Station Addition Capital Projects Fund. So obviously, transfers out of $200,000, cash $200,000. We're just transferring money, right? This is something we've seen, and this relates to a journal entry we've seen earlier in the governmental funds. This book the author is just a continuing thing with just the Village of Riverside. We're just continuing building upon it. Okay, at the year end, several adjustments are necessary. First, depreciation is recorded as an operating expense. So obviously we're going to debit operating expense for depreciation of $122,800. And we're going to credit accumulated depreciation utility plant for $122,800. Same thing here. We know operating expense hits our income statement, our statement of revenues expenses. And accumulated depreciation we know is a contra account to that asset carrying it, right? So same thing here. It's kind of nice being back in accrual based, isn't it? It's a little tricky going back and forth, but it's nice being back to what we know, right? Provision is made for bad debts for utility customers, consistent with guidance provided by GASB. The bad debt provision is a revenue reduction, not an expense. So whenever we actually have a provision for bad debts, then it's going to be a revenue reduction, not an expense. So obviously, hence the journal entry here. Operating revenues, charges for sales and services, 2,200, and then credit allowance for uncollectible accounts of 2,200. Obviously, the reason we debited operating revenues is because that reduces revenues, because revenues is an original credit, right? So if we're crediting it, we know we're receiving the revenue. So if we want to reduce it, we need to debit it. So that's why we're debiting operating revenues as opposed to operating expense, because it's a reduction in revenue when we make a provision for bad debt. Okay, following a provision in the revenue bond indenture, $55,000 was transferred from operating cash to restricted assets category. So obviously we're going to move it from cash to a restricted asset category. So we're going to debit restricted assets for $55,000 and credit cash for $55,000. So we've merely just moved categories, right? We moved it out of cash and into a restricted asset. And remember, in proprietary funds, restricted and is one of the three positions of one of the three items of net position, and restricted comes from outside covenants, right? Like bond and debt indentures and our indentures and stuff. So that's what this is in this case. It's a revenue bond indenture. So we need to restrict those funds, right? So revenue, expense, transfers, and capital contribution accounts for the year were closed to net position account, right? So obviously we've all seen this closing process again. We're just going to merely reverse whatever the original entries were, right? So obviously operating revenues, charges for sales and services for the entire period amounted to $1,053,100. So we're going to debit it because there were original credits. Capital contributions, remember that little fee we put on those developers for the $12,500 that wasn't stipulated to any project. So we just made it a capital contribution for that $12,500. That's what that capital contribution is there. That was an original credit, so we're going to debit it. We incurred these operating expenses, cost of sales and services of $364,000 during the year, so we're going to credit it. Operating expenses throughout the year for administration was $152,900, so we need to credit it because it's an original debit. Same thing with the selling and depreciation, transfers out, and the non-operating expenses of interest. And obviously we close it to net position, right? That's our plug, is net position. And obviously it's the difference between the credits and the debits. So straightforward, right? If it's an expense or revenue, whatever, original debits or credits, you just reverse it. That closes the account, and whatever the remainder is plugged in that position, right? So in this case, net position increased, right? It increased by $19,700. Okay, let's take a look at this right here. So after posting the closing entry that we just went over, right? Net position has a balance of $1,582,720. The beginning balance was $1,563,020 plus the $19,700. So the net position is an increase from that closing entry. So the net position balances to reported in the December 31st, 2020 statement of net position are going to be calculated as follows right here. So obviously, let's just assume these numbers are right because we know it's just too difficult to try to tie through all these entries, you know what I mean, and see what these numbers are. But we know after we've made all these entries throughout the period and closed these entries that this is what our net position is going to look like, right? So let's start here with the net investment in capital assets. So first thing I want to point out is net investment in capital assets. Notice that the first item under net investment in capital assets is the construction work in process of $125,325. So just want to point out that is included. If we have any materials and supplies that are still being tied up in a current project being built, so obviously that's the residual amount left in that account, right? Remember we closed some of it out. Remember we moved the $529,300 out of the account and moved it into the utility plant. Well, we still have $125,325 in there, so we need to keep that as a net investment in capital assets because we know that's temporarily capitalized, right? So we need it. That's still an investment in a capital asset because we have materials and supplies that are being used in it. So that's an important line item. So if that account is relevant and it's got an amount in there, we need to include that in that investment in capital assets. And then obviously from there, we're going to have our utility plant and service, right? And then obviously less accumulated depreciation, less revenue bonds payable, right? So in this case, this outstanding debt was related to the net investment in capital assets, right? Or to the capital assets. The construction work in process was those materials and supplies being used, so that's temporarily capitalized. We need to include that, and obviously the utility plant. So what's the formula again for net investment in capital assets?
It's the capital assets
Right.
minus accumulated depreciation,
Right.
minus related debt outstanding.
Right. And what's the other component that if relevant could factor in that we need to include in the capital assets?
Capitalized supplies.
Right. Which is the construction work in process, right?
Yeah.
Right. So that's that other little nuance there is that construction work in process. If it's got an amount in it, just make sure that we include that in the capital assets, right? So not bad. That's the worst part of the net position is remember that net investment in capital assets because then we know we have to find restricted, right? Which we know restricted is going to be in this case 110,000. Remember that's the original 55,000 that we had in the beginning balance of restricted assets, and then we also moved the cash. Remember because of the bond indenture, the covenant thing that we had to move from cash the other 55,000 because it was restricted from outside sources or outside law. So that's why that 110,000 is restricted there. Then obviously the unrestricted is just the plug, right? So we can see how that works. So net investment in capital assets is $1,070,465. Restricted is going to be $110,000. Unrestricted $402,255 for a total net position of $1,582,720. So pretty straightforward, right? If you can remember the net investment in capital assets, then you've got the bulk of the battle down. Then you just have to remember there's two other items to be accounted for. The unassigned is a plug. We need to know what the restricted is. Usually we won't see restricted in these type of funds, but if we do, we know it's strictly from outside sources, right? Like bond covenants or legislation or something of that sort. So mainly, if you know the formula for net investment in capital assets, and you know what stipulates the funds being restricted, then you can find what the unassigned is. And it's nice to know that we already know what total net position is, and we already see these other items. And now we're going to get into actually looking at these statements again. Okay, so let's just become more familiar. It's been a while since we've looked at statements, so we've seen all these entries and the closing entries and seen how net position is built up. So now let's take a look and get back to the statements and talk about these for a minute. Just see what stuff we have here. Okay. Let's get back up here. Is this it right here? Position. Okay. So we'll start with the statement of net position. The statement of net position, it resembles what sheet that we're used to seeing for profit.
Balance sheet.
It's going to be the balance sheet, right? Because it's the net position. Balance sheet is pretty much showing the net position of a company or equity. Net position is the same thing as equity, right? We just call it net position here, or fund balance for governmental funds. So these are statement of net position for proprietary funds, December 31st, 2020. So first thing I want to point out is notice we have two columns here, right? Business type activities, enterprise funds, water utility, governmental activities, internal service funds. Okay, for simplicity, these financial statements, we're only considering that the government only has two proprietary funds, one enterprise fund, one internal service fund. So that's why it's being displayed like this, right? Because there's only one of each. In reality, on the statement of net position for proprietary funds, we're going to see the first columns that we see is going to be business type activities, right? But it could be numerous. It could be like a power plant, be a water utility, so on and so forth, landfill, whatever the enterprise funds are, right? Well, they follow the same rule for non-major major funds, just like for governmental funds. Remember, only major funds were showed, and always general fund is always major. Well, what was the rule? It was a 10-5% rule, right? 10% of all the assets, liabilities, all the elements, pretty much. We'll just go through all the elements: assets, liability, equities, all that. If it's 10% of all governmental funds plus 5% of the other non-governmental, I believe is what it is. The 10-5% rule is the easiest way to remember. Same rule applies for enterprise funds, okay? So we're either going to have a major enterprise funds or non-major enterprise funds. So let's just assume that there would be more than one enterprise fund, for example, and assume there would be two major ones and two non-majors. So then for business type activities, we would see a total of 4 columns still. We would have one for each major, one for the 2 non-majors in a column non-major fund, remember, and then one for total business type activities, okay, which would be the sum of the 2 majors and then the 2 non-majors in a single column in the total for business type. Then from that point, let's assume we have 3 internal service funds, okay, so we're going to see that under governmental activities, right? For the governmental activities internal service fund, well, they're all going to be combined into one column as if they were all non-major, right? So we're always only going to see one internal service fund. But by nature, we should, if there's more than one enterprise fund, we should see a couple of those because it has to be listed as major, non-major. Only enterprise funds are subject to the major, non-major funds, right? And it's the 10-5% rule. Then there has to be a non-major category for all non-major funds. Business type activities, column total, then a total for all internal service funds for governmental activities. So I just wanted to point that out. This is simplicity. We only have one of each. Next, obviously, we're going to move down to starting with assets. I want to point out, notice it's classified. Remember, it has to be current assets, non-current assets, current liabilities, non-current liabilities, okay? So the format's a lot, other than what we just went over with the major columns, non-major columns, and how it's stated, it's pretty much moving the same as we're used to seeing. We start with current assets, non-current assets, then we can move into liabilities, non-current, right? And then get into the equity for our for-profit commercial statement. So it's kind of the same stuff we're used to seeing here. So we can just see here and just listed relatively, just like any other statement, current assets, order of liquidity, right? Starts with cash equivalents, and we just have the items here: investments, accounts receivable. Notice it's net, so they've already accounted for the allowance, right? So they've just accounted for that within this number here. So that's at net. Due from, materials, supplies, total current assets. We got a line break, right? Then we move to the non-current assets: restricted assets, long-term, advanced supplies fund, capital assets, and notice it's net of accumulated depreciation. So both things carried at net value here has already been accounted. The contras have already been accounted for, right? That's going to be important because if we want to find what the net investment in capital assets is, we need to know that accumulated depreciation has already been backed out for this figure. So therefore, what do we have to account for now? We only have one element: the long-term debt, right? So then we know we can come down here, revenue bonds payable. In this case, for simplicity, they're going to say that's what's outstanding, right? So therefore, net investment in capital assets, if we have capital assets net of accumulated depreciation, 3,770, 465. So then we've already backed out accumulated depreciation. It's net here. So then if we take out the long-term debt that's tied to it, in this case, it's all of the revenue bonds payable, right? Because the advance has nothing to do with it. Only the revenue bonds payable was used for the financing. So 2.7. So if we back 2.7 from the 3,770, 465, we can see we'll get the 1,070,465, 465, right? So not bad, right? It's not bad at all. That's why it's so important to just read these line items, because sometimes they might be tricky and they might give you capital assets. Then they might give you the contra account for accumulated depreciation. You have to add that step. You have to back it out. Sometimes they'll just give it net, as is the case here. And then we know we only had that one other element, right, of the long-term debt. So then we have our net investment. But same thing, let's just back up. I wanted to point that out, just the nets here, because it's really particular. With accounting, we're attention to detail, right? Details really tell us what's going on here. So obviously, current assets, non-current assets, we've already figured out how to get net investment in capital assets, right? So obviously, liabilities next. Start with current We have our accrued liabilities, accounts payable, payroll taxes payable, total current liabilities. We have a line break. Then our non-currents, which is the advance, and then the revenue bonds payable, right? So then we'll have another line break, total non-current liabilities, and then total liabilities, another one. So obviously, if we take total assets and back out total liabilities, we can see that the difference between that and that is going to give us the 1,582,720, right? So we know what total net position is just from looking at the difference between the assets and liabilities, right? We already know what net investment in capital assets is because we've already went through the formula. We found the capital assets net of accumulated depreciation and then back out the relative debt, right? The long-term debt. So we have that. Restricted for bad debt. Remember, we went through what this net position is. You notice these numbers correlate with what we just went over. Remember, we did the math for the 1,170,465. I showed you the breakdown on the previous thing, and I also showed you how to find it within the statement now, right? The relative items that we're concerned with. We know the restricted for debt service was from outside, from the bond indenture, right? We know that amount totaled to 110,000, so we know what the restricted is. Therefore, we know what unrestricted is as well. It's the plug, right? So total net position, the 1,582,720 less the net investment in capital assets of 1,070,465 less the 110,000 gives us the 402,55. That's our plug. Not bad, right? Same thing holds true for internal service funds. Just follow the activities, right? Not bad. So the main thing here with the statement of net position, no, it has to be classified. What that means is assets and liabilities have to be current, non-current. Know that net position has three categories: net investment and capital assets, unrestricted and restricted, right? Restricted is from outside covenants. The net investment is less accumulated depreciation, less outstanding debt, and if there is the temporary capitalized of construction in progress, we need to include that within capital assets as the base before we back that out. Know that there is going to be enterprise funds and internal service funds. Enterprise funds are subject to the major, non-major threshold, the 10-5% rule. So major funds will be presented separately. Non-major will have its own column. Then we'll have a total business-like activities column for all the non-majors, majors of enterprise funds. And then for internal service funds, we're always going to just have one column as if they were all non-major funds, right? So that's pretty much long and short for a statement of net position. Not bad, right? It's not bad. Does it seem pretty straightforward? Okay, next let's get into the statement of revenues, expenses, and changes in fund net position for proprietary funds for the year ended December 31st, 2020. So notice again, I want to point out that the exact same relative corresponding funds is going to be appearing on the relative statement of revenues, expenses, and changes in fund net position, right? Because obviously they correlate with one another. They work off one another. They communicate to one another. So it's going to be the same order of setting up here. You know, if they're major, they're major. If they're non-major, whatever. You know, it's all set up. So right here, operating revenues, charges for sales and services. Obviously, we're just going to punch it in. Main thing. So we know what revenues are. So however many transactions we had that we credited the revenue, that overall amount is what we'll plug into either business type activities or governmental activities, right? Next, we need the operating expenses, right? Because remember, we want to stipulate what operating income is. So for the main thing to start out with the statement of revenues, expenses, and changes in fund net position is it always starts with operating revenues and operating expenses, okay? And then from there, we're going to have obviously total operating revenue, right? So operating income right here. You know, charge for sales and service, operating expenses, cost of sales and service, administration, selling, depreciation, right? So those are the expenses we see within those entries. So then total operating expenses, then operating income obviously is going to be the revenues less expenses will give us the 396,200. Same thing. After operating income, we're next concerned is going to be non-operating revenues and expenses, okay? So in that case, interest revenue, interest expense is what's going to be relative. So that then we have our total non-operating revenues or expenses right here. And then from that amount here, we're going to be able to take our operating income and then back out the total, add or subtract total non-operating revenues and expenses, right? And that's going to give us income before contributions and transfers, right? So obviously next we want to take into account contributions and transfers, right? So capital contributions, there's the 12,500 for when we build those developers. Transfers in 596, transfers out. Remember the water utility fund transferred out that 200,000. So there's where it's being shown on the 200,000, just plain as day. Remember the transfer out, it's showing it right there. So there's the transfer out. Then we'll have the total, the actual change in net position for the period, right? If we go through these line breaks, it's going to give us the change in net position, right? Then we'll have net position, because this is the all-inclusive. GASB requires the all-inclusive approach, meaning we have to reconcile from the change, beginning and ending, right? So that's why this is known as the all-inclusive approach. So if you see that, you know that that's what the all-inclusive approach is. It wants to reconcile to change, beginning and ending period. So the change in net position, we see that, plus we have the beginning net position, we see that, and then the ending net position. So notice that these numbers right here, if we look at these numbers, they directly relate and are the exact same as they were on the statement of net position. Okay, so you can see here the 1,582,720 for business type activities. Let's just look here for a second. Business type activities. Wow, that was too big. 1,582,720. 603,500 for governmental. 603,500 for governmental. So these numbers should match, right? Net position should match on the statement of net position and the statement of revenues, expenses, and changes in fund net position. Just to point that out. So with the statement of revenues, expenses, and changes in fund net position, obviously we're going to have our category for the internal service fund, the enterprise funds. Start with operating revenues, right? Remember the same funds are going to be shown here. Start with operating revenues, back out operating expenses, get operating income, right? From that point, we want non-operating revenues, non-operating expenses, right? That's going to give us our total non-operating revenues, expenses, and that'll give us income before contributions and transfers, right? From there, we go through that, then we get our net position, beginning, ending, right? Pretty straightforward. Not bad. Main thing here is with the statement of revenues and expenses, we have to start with operating revenues, because remember we have a statement of cash flows that's is one of the other statements that's included with the proprietary funds. And when we reconcile the operating income from cash flows provided from operations, we need to start with operating income instead of net income. Because remember with FASB we start with net income. We start with operating income for GASB. So we okay with statement of revenues, expenses? Oops, same one. All right. Now the fund statement of cash flows, right? All right, so as we can see here, Village of Riverside, statement of cash flows, proprietary funds for the year ended December 31st, 2020. Okay, first thing I want to point out again, same thing, same relative funds, right? Business type enterprise fund, governmental type internal service fund. So another thing, remember, GASB has four categories as opposed to 3 for cash flows, right? We have the operating, which requires we have to use what type of method. We don't have an option. We have to do what method. Remember, there's an indirect and a direct. What method does GASB say we have to use? Direct, right. FASB gives us the option, right? And it's only for operating activities, right? Remember, if you recall your statement of cash flows, you have the option for FASB for operating. Investing and financing is built the same no matter what you use, right? It just matters what schedule you have to attach. If you do the indirect for FASB, you have to attach a schedule of interest and taxes paid. Okay. If you do the direct method, you have to attach the reconciliation from net income to cash flows provided from operations, which is in effect the indirect method. So when you hear the indirect method or reconciliation from operating income or from net income to or operating income to cash flows provided from operating activities. Don't get wigged out when you hear that. All that it means is that's the indirect method. And we're going to go through, and I'm going to give you a really, really good tip and a secret and a shortcut to being able to work through the indirect method or the reconciliation, and it'll save you a lot of struggles, a lot of time, and it should be helpful. But with saying that, you have to really know your journal entries, and we're going to spend a little bit of time on it here in just a second. So remember, GASB, 4 statements for statement of cash flows. We have operating. We have 2 financial sections, one for non-capital related financing, one for capital related financing, and then we have the investing section, okay? And we know what activities go into it is a little bit different than that for FASB, right? Okay. So let's just start here at the top with the operating activities. So we can see we start with cash flows from operating activities, right? And we're going to label them relative to each of the funds, right? So the stuff we can expect to see within the cash flows from operating activities is going to be cash flows that include receipts from customers, payments to suppliers, payments to employees, and receipt and payment of cash for quasi-external transactions, which is interfund services provided and used with other funds, right? So just operational type of activities, pretty much. Payments to vendors, suppliers, employees, transfers, stuff like that. So straight operational activities is what we can expect to see, right? So let's look and see here. The items we see here, cash received from customers and departments. That was just said what we would expect to see. And it's cash received, right? Cash paid to suppliers and employees, right? So that's the only 2 items that are relative for these funds. So makes sense. That's what it says we'd see, right? And it's the direct method for operating, right? So if it says cash received from suppliers, we're literally just going to put the cash received from suppliers. So in this case, we received $968,500 for the water utility fund. So we're just merely just say, okay, we received that amount of money, right? Same thing. If we paid it, that's how much we pay. We just put it exactly. Money coming in, money going out. That's, you directly state it as it is, right? Simple. Direct method, simple, right? Now let's move to cash flows from non-capital financing activities. Stuff we would expect to see in here would include proceeds and repayment of debt not clearly related to capital outlays, right? Not related to capital outlays. Grants received from and paid to other governments for non-capital purchases, transfers to and from other funds, and the payment of interest associated with non-capital debt. Okay, so, and it says here, illustration 6.5 is what we're on, makes the assumption that $306,000 of the initial contribution from the general fund to the internal service fund was for working capital. Okay, so remember when the general fund made that transfer, they're saying here $306,000 of that was for working capital, right? Not capital, but like for capital investment, but for working capital. So for operating, right? For our non-capital. So let's see here. Transfer from general fund for working capital, $306,000, right? Because it's for working capital. Because remember, it said transfers from fund to fund would be included here if it's for or for working capital. Transferred to capital projects fund, $200,000, and then obviously that's going to be the net cash provided or used from non-capital financing. That's the only two things that fell within that category that was relative. So that's it for the non-financing capital or non-capital financing. Next, we have the cash flows from capital and related financing activities. This includes proceeds and repayment of debt related to capital acquisition, the receipt of and payment of grants related to capital acquisition, the payment of interest on debt related to capital acquisition, and the purchase of construction or construction of capital assets. So I think here we can see here the only difference in activities between the non-capital financing and the capital related financing is we're really not seeing transfers from fund to fund as much here. Not saying it can't happen, but the main thing here is just what it's for, right? it's the same elements. We're seeing interest and all this other stuff. The main difference is what are you using it for? Is it for working capital or is it for to finance capital projects? That's the main difference between the financing, right? So just interest is going to be accounted for in either one of them, right? As opposed to operating, because in FASB it's operating. In this case, interest is tied to whether it's capital or non-capital. So that's just really pay attention to whether it's capital or non-capital, and that'll decipher to whether you need to put it in either one of those cash flow categories. Next, cash flows from investing activities. This is going to include cash used to acquire investments, whether directly through investment pools, the interest received on such investments, and cash received from the sale or redemption of investments. Note that cash flows from investing activities do not include acquisitions of capital assets, as is the case with FASB requirements, right? So in FASB, when we buy and sell capital assets, that's investing, right? For this, when we buy and sell capital assets, that's in the capital asset financing section. For investments, we're merely concerned about investments. So when we buy marketable securities and stuff of that sort, right? So that's pretty straightforward. It's pretty much. I think FASB is almost easier in a way. It makes more sense because operating is operating. They say you have to do the directs, which means, it's just money coming and going. You just trace the source. They split up non-capital, capital financing, and then interest or investment. Is just investments, right? So not bad. The next section that I want to point out is going to be the reconciliation of operating income to net cash provided or used by operating activities, right? Remember, this is what I said. This is going to be the indirect method, right? Okay. So, a reconciliation is required between the statement of revenues, expenses, and changes in fund net position and the statement of cash flows. The reconciliation should be between operating income. Remember, operating income, not net income. FASB, you start with net income. GASB, you start with operating income. So once again, that's what's so important on that statement of revenues and expenses. We start with operating revenues and expenses, then move to non-operating, Then before we get to contributions of capital and then transfers and so on and so forth. So really make sure we stipulate the difference between operating and non-operating because we need that operating line break to be able to reconcile on this statement of cash flows. So let's just see here. So obviously it starts with operating income or loss, right? So if we recall back on this statement of revenues and expenditures and changes in fund net position, we had operating income at the very top of $396,200 at the top. So if we just think back in our mind, a little mental image, remember it was operating revenues, operating expenses, then we had the line item. Well, that line item was $396,200. And it was $4,500 for that of governmental activities. But for simplicity, I'm just going to focus strictly on the reconciliation, strictly on the water utility fund right here, okay? So we always start with operating income, right, when we're doing this reconciliation, tying in the statement of revenues and expenses to the statement of net position, right? Or I'm sorry, to the statement of cash flows. So operating income was $396,200. So let's think here. We have to do an adjustment to record operating income loss to net cash provided, in fact, operating activities from operating income. Let's think. Okay, we're tracing what on this statement? On the statement of cash flows, what are we tracing? Movement of cash. Cash uses, cash sources. We want to know to where it's going, right? Statement of cash flows, where the cash is flowing within the business. What is a non-cash expense that proprietary funds is going to recognize? It's an operating expense, but it's a non-cash expense. Think about the matching concept. What does an asset do if we buy a fixed asset? What is it going to do? Why do we capitalize a fixed asset? You're right. It's subject to depreciation, but depreciation, you're getting there. But why do we capitalize a fixed asset instead of expensing it? It's going to produce money for us, right? Longer than one period, right? Because remember the matching concept. We want to match expenses with revenues. Remember, same with proprietary funds, match expenses with revenues. So we know these funds are also recording depreciation, right? Remember, it's a systematic approach of matching expenses with revenues, because that asset is going to produce revenues for different periods. So we want to systematically spread up the cost of that asset to match it with the revenues it produces, right? So therefore, by having that systematic system of depreciation, every single operating period that we incur a period of depreciation expense, that's an operating expense, right? So it's reducing our income, but it has no effect on cash, right? Because there's no cash flow. It's just a systematic way of expensing it. It's just so it keeps the matching, right? So therefore, depreciation is a non-cash expense, right? So if it's a non-cash expense, if we've already said, okay, if we've counted it as an expense but it didn't affect cash, what do we have to do with depreciation?
So,
During the reconciliation, how should we treat it? Should we add it back or should we subtract it? We need to add it back because we subtracted it out, right? We're saying we took it, we realized it as an expense, right, on the P&L, just to match revenues with expenses. But in all reality, there was no effect on cash. So we're saying cash is really lower than what it really is. So we need to add that back. So the first thing on this reconciliation thing that we want to do is we want to start by adding back depreciation if it's subject, or amortization, whatever it might be, because those are non-cash expenses, right? Or depletion. So depreciation, amortization, or depletion. If you see any of those, that's a non-cash expense. We need to add it back. Okay. Do you have just a second? I know we're out of time here. I'd like to go over this real quick, and then I want to start with this again on Friday, just so you can marinate on it over the next couple of days, because this is really, really useful here. Okay, so remember we start this reconciliation with the operating income, right? Next, we add back depreciation, amortization, or depletion, right? Because it's a non-cash expense, so we need to add that back. Next, we need to take into effect the changes in assets and liabilities, right? So what do we mean by that? So if there's an increase in customers' accounts receivable, we're subtracting that, right? But accounts receivable went up, but we're subtracting it, right? Watch this here. So increase or decrease in inventory. In this case, inventory decreased, right? It went down. So that means inventory is a regular debit, right? So if inventory decreased, what did we have to do in order to bring that account down?
you had to credit.
Credit it, right. Here, watch this. Debits, you subtract out. Credits, you add back. But it's what happened during the period, whether it was credited or debit, not if it was original. Well, we have to keep up with it. So if increase in customer accounts receivable, if it increased throughout the year, what kind of activity was being hit? Was it debit or credit? If it was original asset, if it increased, it went up, right? You debited it. What do we do with debits? We subtract them. So if accounts payable went up, you credited it, right? So you have to add that back because it credited. Credits you add back. Does that make sense? So that's the formula there. So debits you subtract, credits you add back. And you got to think, okay, AR, it's an asset. We debit assets originally. If accounts receivable increased during the period, you got to think about it. Okay, that means we debited accounts receivable. We need to subtract out debits. So I'm going to subtract that. If it's a liability, accounts payable, okay, accounts payable is original credit. They increased. That means we had to credit that account. We have to subtract, or we have to add back credits, right? So we add it back. Easiest way to do the reconciliation. So if you start with operating income, and then you got to add back your non-cash expenses, which is depreciation, depletion, or amortization. Then you keep up. Then we have to move in the change in assets and liabilities. That's the hard part of the change in assets and liabilities. Just remember, you add back credits and you subtract debits, and then that's relative, and then that'll get you all the way to the bottom. And we'll get a little more in depth into that as we move forward. On Friday, so we'll wrap up Friday right there. We'll pick back up there, and then we'll get into our review as well. Did that help on the reconciliation thing right there?
Yeah.
That's the easiest way. Just if you can keep up with what's debits and what's credits, the original. See why journal entries is so key to like so much in accounting. If you know journal entries, you know financial statements, you know rules of messing with that. Because if you try to think of it another way other than the add and subtract, I still can't do it. I still get confused doing it. It's a lot. But that's the easiest way. Just remember add and subtract back. So we'll pick up with that on Friday and do the exam review. That's it. Everyone have a good day today, and I'll see everyone on Friday.